Global capital is currently piling into British government debt as the safe trade. This is the bond market that blew itself up in the autumn of 2022 and needed an emergency Bank of England rescue to stop UK pension funds from going under. Meanwhile, the 30-year US Treasury recently pushed above 5.2%, a 19-year high. And if you ask the people making that trade why, they keep giving the same two reasons. One is the US intervention in the Japanese yen, and the other is a man named Kevin Warsh. What was once the safest asset on Earth is being demoted, and the reason comes down to who now answers the phone at the Federal Reserve. So today, we're breaking down how Warsh ended up in that chair, why his hawkish record hasn't brought him a single crumb of credibility, and what happens to markets when investors stop trusting the Fed. My name is Lewis, and this is the Coin Bureau. Now, let's start our deep dive back in May, in the East Room of the White House. Warsh was confirmed as Fed chair by the Senate on the 13th of May by a vote of 54 to 45. That's the narrowest confirmation margin for a Fed chair in modern history. Exactly one Democrat crossed over, Pennsylvania's John Fetterman, and the whole process had been held up for weeks by Republican Senator Thom Tillis over a criminal probe into Jerome Powell about the cost of renovating the Fed's HQ. That probe was dropped in April, and the path cleared. Then came the swearing in. It was held at the White House, and that was the first White House swearing in for a Federal Reserve chair since Alan Greenspan in 1987. In the room, you had Justice Brett Kavanaugh, Treasury Secretary Scott Bessent, National Economic Council Director Kevin Hassett, House Speaker Mike Johnson, and a good chunk of the administration. And standing next to the new chairman of the world's most important central bank, President Trump said, and I quote, "I want Kevin to be totally independent. Don't look at me, don't look at anybody. Total independence." Reassuring, to be honest. Now, at a glance, you might have said Warsh wasn't the proper pick for Trump. Warsh has been a hawk, and Trump wants cuts. At the FOMC meeting back in July, the committee voted 9-3 to hold the federal funds rate at 3.5 to 3.75%. That was the fifth consecutive hold of 2026. And the three dissents weren't doves. Beth Hammack of Cleveland, Neil Kashkari of Minneapolis, and Lori Logan of Dallas all wanted a 25 basis point hike. That's the first time since September 2016 that three FOMC members have dissented in the same hawkish direction. Warsh told Congress on the 15th of July that the committee has, quote, "no tolerance for persistently elevated inflation," and pledged to make high inflation a thing of the past. He's described the internal disagreement as a family fight so many times that it's becoming something of a running joke among Fed watchers. Core PCE inflation is running around 3.4% year on year, pushed up by the oil shock from the Iran war and by tariffs. And this Fed has not cut once into it. So, the guy Trump handpicked has spent the first 3 months refusing to give Trump the one thing Trump has spent 2 years demanding. That is cuts. And yet, the market still doesn't fully trust him. And that's the key point here. Fed credibility isn't just about what you do once you're in the chair. The markets have to believe your decisions are properly independent in the first place. Warsh arrived with that question already hanging over him, and a few hawkish decisions haven't been enough to make it disappear. Warsh's father-in-law is Ronald Lauder, the Estee Lauder heir and World Jewish Congress president, who has been a friend of Donald Trump's for roughly 60 years, going back to their days together at Wharton. According to reports from the Wall Street Journal and Bloomberg through 2026, there were repeated phone calls between the president and the new chair on macro shocks. Then, in August, Trump told reporters he'd spoken to Warsh, quote, "one time briefly a few days ago." If you believe that, I'm not sure what to tell you. Warsh and Treasury Secretary Bessent, meanwhile, hold weekly breakfast meetings, and both men were trained by the same person, the legendary macro investor Stanley Druckenmiller, and many refer to the pair as capital flow practitioners rather than central bankers. So the Fed and the Treasury are now being run by two people from the same school of thought who talk constantly. And the market did the rational thing. It started focusing much more on Warsh's incentives rather than anything he says publicly. He refuses to cut. He holds 5 meetings in a row, 3 of his own colleagues want to go tighter still, and the long end of the curve still sells off anyway. A hawkish Fed and rising 30-year yields is not a normal combination. Something else is being charged for, and there's much more to this than simple economic theory. Now, tracking a story with this many moving pieces is quite the challenge, which is why we made it easier for you. Because right here on YouTube, you can actually join the Coin Bureau Club Lite plan. You'll get daily coverage across both TradFi and crypto, our teams read on how the market is positioned and where the opportunities are, and none of the nonsense. We've made the Lite plan affordable, so it's accessible to all, and if you sign up now, your first month is absolutely free. Just tap the join button below this video to get started. Now let's get back to the Fed. We should probably inject some balance at this point, because this is a very neat story, but the bond market has plenty of other things to worry about beyond Fed credibility. Roughly $18 trillion of new sovereign debt is expected to be issued globally in 2026. US federal debt still sits near $40 trillion, and net interest expense this year is projected to clear $1 trillion on its own. Add an oil shock that took WTI crude to around 113 earlier this year, and a fresh round of tariffs, and you have more than enough supply and inflation to explain a 5.2% long bond without ever mentioning Kevin Warsh. So let's narrow the critique to the part that's harder to argue with. Warsh has been asked in congressional hearings, in more or less plain terms, who he actually works for. Not whether his policy is correct, but from whom he takes orders. And no chair in the modern era has had to sit through that question as a serious line of inquiry. Put the pieces together, the weekly breakfasts, the shared mentor, the public push to redirect Fed facilities, and it's not hard to wonder whether the Treasury is setting the agenda here, rather than the other way around. Now, this all stops being abstract if you just look at who's actually meant to be buying America's long-dated debt. Because the biggest buyer on the planet has now actually become a seller. Japanese investors net sold 4.67 trillion yen of US government, agency, and municipal bonds in the first quarter of 2026. That's roughly $29.6 billion, and it's the largest quarterly reduction since the second quarter of 2022. In May alone, Japan's Treasury holdings fell by $66.7 billion, the biggest monthly drop in nearly 4 years. Japan is still the largest foreign holder of US government debt at somewhere around $1.14 to $1.2 trillion, ahead of the UK and China. But the direction has changed, and the reason is the currency. By late July, the yen had hit 164 against the dollar, its weakest in 40 years. On the 30th and 31st of July, Japan and the United States ran a coordinated yen buying intervention, the first joint operation of its kind since 1998. Estimates of Japan's 2-day outlay range from $75 billion to $88 billion, with Goldman Sachs putting the first 2 days around $85 billion. The American side was tiny by comparison, and we know roughly how tiny because a photographer at Camp David got a clear shot of Besson's notepad, which read, quote, "Buy Japanese yen 5 to 10 bill." The New York Fed funded the US leg by selling euros rather than dollars, and the ECB only found out afterwards. And by the middle of August, the yen had given back about half of it, drifting back towards 160. Ouch. So here's the apparent fix. The Fed runs something called the FEMA Repo Facility. That's Foreign and International Monetary Authorities, which lets a foreign central bank pledge its treasuries as collateral to borrow dollars rather than dumping the bonds into the open market. It was created in March 2020 and made permanent in July 2021, with a cap of $60 billion per counterparty. But Bessent has been pressuring the Fed to upsize it so Japan never has to sell treasuries to defend the yen again. That's striking and a rare overstep. A Treasury Secretary issuing a public directive to a supposedly independent central bank. And as of the middle of August, the Fed's weekly balance sheet data showed the foreign official repo line sitting at 0, unused for 8 straight weeks. So this is a facility being widened in advance for a demand problem that nobody in Washington wants to publicly acknowledge. Now, why is all of this relevant to the average Joe? Well, because the Fed controls the starting point for the price of money. And that rate feeds into the value of virtually every other asset out there. The US Treasury curve is the risk-free rate. Every equity valuation, every mortgage, every credit spread, and every discount rate applied to every long-duration asset is calculated off of it. And if markets stop believing the Fed is truly independent, that loss of credibility gets priced into everything. So, if you hold crypto, or gold, or frankly anything at all, here are some of the things worth watching as this question of Fed independence continues to get processed by the market. First, whether long-term yields keep rising while the Fed holds rates steady, because that's the strongest sign markets are losing faith. Second, whether that FEMA facility ever gets used, because that would make the Treasury demand issue very serious. And third, whether Japan keeps selling. Some estimates have sustained Japanese selling, pushing the US 10-year yield 20 to 50 basis points higher. One other thing though, don't necessarily expect a governance repricing to materialize as some kind of crash. It often just means a lasting increase in the cost of borrowing for the United States. Which brings us to the irony in all of this. Central banks have been net buyers of gold every single year since 2022, and they are not buying it because they like shiny things. They're hedging against the dollar, using an instrument the US government ultimately controls and can lean on with a phone call. But precious metals have no chairman. And there's one other asset in that category. An asset born from the idea of removing financial intermediaries entirely, and designed for a world where monetary policy starts answering to politicians. Bitcoin's problem this year is that it spent much of 2026 being traded as a high beta risk asset, moving with tech rather than against government risk. That may continue for a while, but if long-term yields keep rising because markets don't trust the Fed, then the case for Bitcoin gets stronger and stronger. Fed independence used to be taken for granted, but it now has a price, and it's getting expensive. But what do you think? Is Kevin Warsh independent, or is he beholden to the will of President Trump? Feel free to get highly opinionated in the comments down below. And if you want the full story of that July intervention, how Washington sold euros to buy yen and told Europe afterwards, well, then definitely check out our breakdown right over here. Thank you all so much for watching, and I'll see you again in the next one. This is Lewis, signing off.